Picture this. You've saved for years, finally built up enough courage to invest in the stock market, and within months, maybe weeks, you watch your hard-earned money disappear. The panic sets in. The regret burns. You pull out at a loss, swearing you'll never invest again. But here's the question that should terrify you. Why does this happen to 90% of people who try? Is the game rigged from the start? And what aren't the so-called experts telling you about where your money actually goes? What if everything you've been told about building wealth in the stock market is designed to extract your money rather than grow it? Stay with me, because what you're about to discover will change how you see investing forever. Let's start with a number that should make your blood run cold. According to the DALBAR Quantitative Analysis of Investor Behavior, updated through 2024, the average retail investor earned just 3.6% annually over the last 20 years, while the S&P 500 returned 9.8% during that same period. Think about that gap for a moment. That's not a small difference. That's the difference between retiring comfortably and working until you physically can't anymore. We're talking about potentially hundreds of thousands of dollars vanishing from your future. A study published in 2023 by the University of California analyzed over 10 million brokerage accounts and found that a staggering 89% of active retail traders lost money over a 12-month period. Not broke even, lost money. But here's where it gets darker. That money didn't just evaporate into thin air, it transferred from your pocket into someone else's. The stock market isn't a wealth creation machine for most people. It's a wealth transfer mechanism, and you need to understand why. The first invisible hand reaching into your wallet is your own mind. Your emotions are being weaponized against you, and you don't even realize it's happening. Behavioral economists Daniel Kahneman and Amos Tversky won a Nobel Prize for proving that humans are fundamentally irrational when it comes to financial decisions. We're hardwired with cognitive biases that make us terrible investors. Loss aversion, the psychological principle that losses hurt twice as much as gains feel good, causes you to sell at the worst possible time. Remember March 2020, when COVID-19 crashed the markets and the S&P 500 dropped 34% in just 23 trading days? Millions of terrified investors sold everything, locking in massive losses. What happened next? The market not only recovered, but reached all-time highs by August. Those who panic sold missed one of the fastest recoveries in history. Then came 2022, when inflation fears and interest rate hikes triggered another wave of panic. Retail investors pulled out $160 billion from equity funds that year, according to Morningstar data. And what happened? 2023 saw a 24% gain in the S&P 500. Do you see the pattern? You're programmed to buy high when everyone's excited and sell low when everyone's terrified. The institutions know this. They count on it. But why does this keep happening? Here's what they don't advertise. The fees silently devouring your returns like termites eating through the foundation of your financial future. You see a mutual fund with a 2% annual management fee and think, that's not much. But let's do the math that financial advisors hope you never do. Imagine you invest $100,000 with a 7% average annual return over 30 years. Without fees, you'd have $761,225. With that seemingly small 2% fee, you'd have $432,194. That's $329,031 gone, 43% of your potential wealth extracted by fees alone. The compound effect works both ways, building wealth for you or building wealth for fund managers. And it gets worse. Trading costs, bid-ask spreads, expense ratios, 12b-1 fees, load fees, there's an entire vocabulary designed to obscure how much you're really paying. A 2025 study by Vanguard found that the average actively managed mutual fund charges 0.66% annually, while index funds charge as little as 0.03%. Over a lifetime, that difference represents tens of thousands of dollars. But the fee extraction doesn't stop there. Every time you trade, you create a taxable event. Short-term capital gains are taxed as ordinary income, up to 37% at federal level, depending on your bracket. The IRS becomes yet another hand in your pocket, and high-frequency trading, triggered by emotional decisions, accelerates this wealth drain.
Now let's talk about the most seductive lie in investing: market timing. You've heard the stories. Someone who sold right before a crash or bought right before a rally. It sounds possible. It sounds like skill. It's not. It's luck, and the data proves it. Putnam Investments analyzed market returns from 2004 to 2023 and discovered something stunning. If you missed just the 10 best trading days during that 20-year period, your returns would be cut in half. Half! But here's the impossible problem. Those best days often happen right after the worst days. In 2020, 6 of the 10 best trading days occurred within 2 weeks of the 10 worst days. To successfully time the market, you'd need to be right twice, knowing exactly when to get out and exactly when to get back in. Even legendary investors can't do this consistently. A comprehensive study tracking professional fund managers from 1992 to 2022 found that 92% of actively managed funds failed to beat their benchmark index over 15 years. These are professionals with research teams, proprietary data, decades of experience, and billion-dollar resources. If they can't time the market, what makes you think you can? Here's the dark comedy. Fidelity conducted an internal performance review and found that their best-performing accounts belonged to people who were dead or had forgotten they even had accounts. They didn't trade, they didn't panic, they just held. The stock market rewards patience and punishes activity.
But maybe you think you can outsmart the system with information. Maybe you follow financial news religiously, watch CNBC, read analyst reports, and scan Reddit forums for the next big thing. Here's what you need to understand. By the time information reaches you, it's worthless. The market you're competing in isn't the market from 1980 or even 2010. In 2026, high-frequency trading algorithms execute millions of trades per second, responding to news before your brain can even process the headline. According to the SEC, algorithmic trading now accounts for 60 to 73% of all U.S. equity trading volume. These algorithms have direct market access, co-located servers positioned feet from exchange computers to reduce latency by microseconds, and sophisticated AI models analyzing patterns you'll never see. When a major news event breaks, an earnings report, economic data, geopolitical crisis, institutional traders with Bloomberg terminals and proprietary research teams are acting on it before the information hits mainstream news. By the time you read an article and decide to trade, the price has already moved. You're not making an informed decision, you're reacting to information that's already been priced in. Michael Lewis exposed this in his 2014 book, Flash Boys, revealing how the market is structured to give advantages to those with superior technology and speed. Nothing has changed since then, except the technology has gotten faster. Social media has made this information asymmetry even more dangerous. Remember GameStop in January 2021? Retail investors on Reddit's Wall Street Bets drove the stock from $17 to $483 in weeks. Some early buyers made fortunes, but the vast majority who jumped in late, driven by FOMO and social media hype, lost everything when the stock crashed back down. Pump-and-dump schemes that once required organized crime now happen openly on Twitter and Discord, and retail investors are the ones left holding worthless shares. Let's address the elephant in the room: commission-free trading. Robinhood and similar platforms eliminated trading fees, supposedly democratizing investing. But have you asked yourself how these companies make money if they're not charging you? The answer is payment for order flow, a practice where brokers sell your trade information to market makers who execute your orders. In 2023, Robinhood generated $1.87 billion from payment for order flow. They're not working for you, they're selling your order information to firms that profit from trading against you. But the deeper problem is psychological. When trading is free and easy, literally gamified with confetti animations when you buy a stock, it stops feeling like real money. It feels like a game. And that's exactly the point. The average holding period for stocks in the 1960s was 8 years. By 2020, it had dropped to just 5.5 months. In 2023, it was down to 3 months for retail investors on popular trading apps. You're not investing anymore, you're gambling. And every time you trade, you're triggering tax events, potentially buying high and selling low based on emotion, and feeding the machine that profits from your activity. The casino doesn't care if you win or lose individual hands. It cares that you keep playing, because the house edge guarantees profit over time. Wall Street works the same way.
So who are the 10% that actually make money? What do they know that you don't? The answer is going to disappoint you because it's not exciting, it's not sexy, it's boring. The investors who consistently build wealth do the opposite of everything that feels natural. They invest regularly regardless of market conditions, a strategy called dollar cost averaging. When the market drops, they don't panic and sell. They see it as a sale and keep buying. They hold investments for years or decades, not days or weeks. They minimize fees by using low-cost index funds instead of actively managed funds. They automate their investments so emotion never enters the equation. They max out tax-advantaged accounts like 401ks and IRAs, letting the government subsidize their wealth building. Warren Buffett, one of history's greatest investors, made a bet in 2007 with hedge fund manager Ted Seides. Buffett bet $1 million that a simple S&P 500 index fund would outperform a collection of actively managed hedge funds over 10 years. The result? The index fund returned 125.8%. The hedge funds returned just 36.3%. It wasn't even close. Buffett's message was clear. Stop trying to beat the market. Own the market. Let compound interest work its magic over decades. But that advice doesn't generate trading commissions, management fees, or clicks on financial news sites. So it's drowned out by noise.
Here's the truth they don't want you to understand. The financial industry is designed to extract wealth from you, not build it for you. Wall Street's business model depends on activity, trading, fund management fees, commissions, spreads. They profit whether you make money or not. In fact, in many cases, they profit more when you lose. Financial media needs volatility because fear and greed drive viewership. Market stable, long-term investing works, doesn't get clicks. Market crash coming, 3 stocks to buy now does. Brokerage firms benefit from frequent trading. Mutual fund companies charge ongoing management fees whether they outperform or not. Financial advisors often receive commissions for selling you specific products, regardless of whether those products serve your interests. A 2024 study found that 73% of financial advisors are not fiduciaries, meaning they're not legally required to put your interests first. The conflict of interest is baked into the system. Payment for order flow, soft dollar arrangements, revenue sharing agreements, there are countless ways that the industry profits from your activity and your losses. This doesn't mean everyone in finance is malicious, but the incentive structures are fundamentally misaligned with your goal of building long-term wealth.
So what's the path forward? How do you join the 10% instead of being bled dry by the 90% trap? First, accept that you cannot beat the market consistently through trading or stock picking. Decades of data prove this. Instead, own the entire market through low-cost index funds like Vanguard's Total Stock Market Index or S&P 500 funds with expense ratios under 0.05%. Second, automate everything. Set up automatic monthly contributions so you're investing regardless of whether the market is up or down. This removes emotion from the equation entirely. Third, maximize tax-advantaged accounts. A 401k or IRA gives you either immediate tax deductions or tax-free growth, depending on the type. This is free money from the government that compounds over decades.
Fourth, extend your time horizon. If you're not willing to hold an investment for at least 5 years, preferably 10 or more, don't buy it. The stock market is volatile short-term, but remarkably consistent long-term. The S&P 500 has never had a negative 20-year period in its history. Fifth, ignore the noise. Turn off CNBC. Stop checking your portfolio daily. Unfollow stock tip accounts on social media. The more you engage with market noise, the more likely you are to make emotional decisions that destroy wealth. Sixth, understand the difference between investing and speculating. Investing is allocating capital to productive assets and letting compound growth work over time. Speculating is betting on short-term price movements. One builds wealth, the other transfers it. Here's the final question you need to ask yourself. Are you investing or are you gambling? Because the stock market offers both possibilities, but only one path leads to financial freedom. The system is designed to make you feel like you're in control, while slowly extracting your wealth through fees, emotional manipulation, information asymmetry, and incentives misaligned with your interests. But it doesn't have to be this way. The 10% who succeed aren't smarter than you, they aren't luckier. They simply understand the game being played and refuse to participate in the parts designed to make them lose. They've broken the illusion. Now you have too. The question is, what will you do with this knowledge? Will you keep chasing the next hot stock tip, trading on emotion and feeding the machine? Or will you choose the boring, proven path that actually builds generational wealth? The choice is yours, but the clock is ticking. Every day you wait is another day of potential compound growth lost forever. If this video opened your eyes to how the market really works, hit that subscribe button for more finance insights that cut through the noise and tell you the truth. Like this video if you finally understand why most people lose money, and drop a comment below. Are you part of the 90% trying to change, or have you already figured out the game? Let's talk about it.